Hey, Helen, thank you very much for joining me.
Hi, thanks for having me.
Let's just do a little bit of background on you and Articulate, which you launched, I think, in May this year.
That's right.
What's your background? Or like, what point in your career did you think VC is for me? Like, was there an experience you went through or a turning point?
So this is my 20th year in San Francisco. I think tech was not something that I moved here even for. I worked in advertising. I moved here from Chicago, and my accounts were tech accounts because that's what was in the Bay Area. And then in 2008, I got recruited by Facebook, and so they were building out, the product marketing team to develop like brand advertisements, and that was my background. So I got to be an early team member there, and so that was my first foray into tech. And so here I am, many years later. But it was quite accidental, and I think to your question of was it my intention to go be an investor one day? No, but I did start angel investing many years later when I was at Plaid. So I ran marketing and communications at Plaid from 2017 to 19, and that was a really fun run for Plaid. It was, I think, the sort of the years that they got on the map and got to position themselves as infrastructure for fintech or the plumbing for a very fast moving, fast growing category. And 2017 was kind of the year that Bitcoin, Coinbase, Robinhood started to become household names. So to attach yourself to being like the infrastructure for those companies was a good position to be. I think our goal was, can we position Plaid to be the AWS of fintech? And as a result, a lot of founders who were either building API companies or fintech companies would just start inbounding and say, "Hey, would love to have you advise or have you involved in some way." And when you're an operator, you're like very locked in and heads. You're not like thinking about deal flow. Is basically what I'm saying. And so I'd meet a team or it'd be a referral, or maybe it was somebody I used to work with I thought was really smart. I just started writing small checks. And so that's kind of how I started building a track record, without an intention to one day be running a fund or doing this full time. But that's kind of when I started to invest. And some of those companies, turned out to be some winners. So that's kind of how I got into it.
I think it's a real strength of San Francisco and hard to reproduce elsewhere that there is such a culture of angel investing, and that is like a very natural on ramp to venture capital. Particularly, obviously, it solves the problem of track record, which a lot of new managers have. If you have some years of angel investing, you can show LPs that. But I'm curious, how do you think LPs generally view angel track records? Is there like a one for one equivalence with performance when they're trying to understand how you'll function as a VC? How do you think they look at that?
I think that you're absolutely right. It's very unique. Even people who are early in career, here and in Silicon Valley, who don't have a ton of liquidity, right? And they're not making a ton of money. They're angel investing really early, and these are really small checks. And so, absolutely right. It's pretty unique to this ecosystem. And the other thing, slightly tangential, but the other thing I think that's pretty unique to this ecosystem is when founders have exits, they immediately put it right back into the ecosystem, right? So that's pretty unique to this asset class and pretty special in my opinion. But angel track records are sort of like, it's really a case by case basis. So I think people are very black and white on like whether it does count or it doesn't. If you have a banger in there and you were like, literally in the pre-seed of Anthropic, like that's probably something pretty meaningful for your angel track record, right? But generally speaking, I think I had 30 companies as an angel investor before I started a fund. And I was told many times, like, oh, we don't really view that as track record. And I have to say, I agree. It is quite different to be writing small checks of your own and not really doing like the thorough sort of portfolio value and tracking versus thinking about how you're managing outside capital, right? So as a result, I wanted to use a lot more of the products, and so I started investing in SPVs. I ran a syndicate with the CMO of Carta, and so it was kind of fun. Like the CMO of AngelList and Carta had a syndicate. We only let other CMOs join as LPs, and then we like voted on like three companies that were MarTech companies to invest in. Like, oh hey, you could have a line item of a bunch of helpful, people who are your ICP, and so that was fun. I became an LP in four funds just to see what the experience would be like. As part of onboarding as an Angelus employee, regardless of whether you're an executive or right out of college, they make you actually run an SPV, so you like understand the mechanics of how the product works. I literally did everything you possibly could. And then and then in 2021, late 2021, I actually left AngelList to start a fund with a longtime friend. And it was like a micro fund, and we made 23 investments. And so I did all of these things to sort of prepare me for this moment where I am now a solo GP running a $10 million pre-seed fund. I guess one other thing, I'm a venture partner at True Ventures, which is a 20-year-old seed firm, which is a very, very, very lucky thing, I think, to have my own fund that I run and then also get to be part of a large platform too at the same time.
Let's say you were you 8 years ago, but you kind of move forward in time to now, and you were beginning your career as an angel investor now, or maybe as like a venture partner somewhere. Like, how different do you think the experience would be if you were trying to start today versus back then?
I think it was pretty frothy, even when I started. So people say ZERP started around 2018. And so it's kind of around the same time I started writing checks. So some differences. I do think that low interest rates and COVID in many ways, like downstream effects of people making Zoom, their default way to meet people and do business, really accelerated a lot of the activities that grew venture. Venture used to be this cottage industry. It was tiny. It was like the tiniest little part of PE, which already was not so big, right? When you think about all of the entire finance world. And it felt like, and I saw this firsthand at AngelList. I was at AngelList from late 2019 to late 2021. So really captured COVID and also ZERP and a lot of the like frenzy around emerging managers and first time managers and activities and SPVs. Like we really saw it, in our business, being able to capture all of that excitement. So I think that venture has just gotten a lot bigger and it's become more mainstream in many ways. I think there's just interest and curiosity in the asset class didn't exist as much before. And I think that this goes through waves. I think this happened after Facebook went public as well. I think people started leaning in and saying, "Oh, you can make money from a tech startup? Like that's interesting." And it's like, yes, this happens every 8 years or so. Like we come to this realization, and then there's like a downturn, and then we learn it again. But I really think that the growth during ZERP and COVID, kind of changed the industry to what it is now, and now it feels big, it feels crowded. I joke in San Francisco, literally everyone you meet is an investor. I just found out my neighbor, like 3 doors down, was an early investor in Coinbase, and he like doesn't even work in tech. It's like everybody has money and everybody has access to some opportunity. And so it's just a much bigger industry.
There's a kind of general conversation going on about like the state of tech, the public opinion of tech as well. The public hasn't enjoyed the same upside of tech as they would have done in the past, perhaps. Obviously, in San Francisco, that's less of an issue because far more people are involved, and like maybe there's a bit of like an echo chamber issue there. They don't see like what the rest of the country feels about tech, perhaps.
Definitely. So I grew up in Buffalo, New York, so Western New York, not even, close to Manhattan. And so I like to remind people that like, yes, I've been here for a while, but my default and, where my friends and my family live is very much in the Midwest, and where tech is not a dominant industry, and, not everybody has a venture portfolio. So I think that the question about it being like this asset class that was small, and the people who understood it understood sort of the quirks about the illiquidity, almost being like a feature and a bug, and these really long-term, timelines for when you see outcomes. The power law. I mean, I I had this opportunity to host a dinner in Houston with a bunch of family offices, which was so nice. One of my founders organized it, and it was such a great and funny experience for me because these were extremely sophisticated people and very successful, but had zero exposure to venture. And I almost had this out of body experience where I'm explaining the mechanics of my fund and, sort of the state of early stage venture. And you're just like, wow, this sounds insane. This sounds absolutely crazy. And it is, but I think that we think of it as normal, right? And it's this sort of swing for the fences, hold, never sell. It's a very interesting dynamic and culture, and we have just enough, extraordinary stories where I think that keeps the lore and the excitement of like, well, you just never know, and you invest in great people and great things happen. And as somebody with a marketing background, people are very good at telling stories looking in the rearview mirror, and you can kind of piece together any story you want using any data you want to support the point that you're trying to make. And so I think there's a lot of that happens, um, especially when people cite data, right? They're very selective on on what data they cite to support what they want to say. But I think that the biggest thing is really that it's a unique asset class. It's been illiquid for so long and it's gotten so big that sort of the scale of the challenges of it being illiquid, are starting to compound. And a topic that you're starting to see kind of circulate around Twitter and conversations is sort of like, this used to be a very long-term patient asset class, and now the impatience of it is really starting to show, and you're starting to see the infrastructure built around sort of that lack of patience. And so continuation funds, like they're like every emerging manager who starts a fund one right now, they're actively thinking about how they talk about, DPI. What are their philosophies around, distributions, and how quickly do they think they're going to be out of the J curve? Like, these were not questions that were asked of emerging managers, I think, even just like 5 years ago. And so I think those changes, and then even SpaceX, like, very happy it's public, and I think it's volatile. As a Facebook employee that rode all of that volatility, I think this is all very normal, and it doesn't really
For
signal
sure.
very much for the long run. But you wake up and you read a headline from the New York Times or Wall Street Journal, and they'll report on the volatility as if it's like the worst thing, right? And that it's a signal that this is going to fail, and you're like, well, this is what most of the country reads. And so I think that it's everything is, the stakes are higher because there hasn't been liquidity, so everybody's watching. The industry has grown and it's become more mainstream. The TV shows, movies, like pop culture references around venture, and so I think more people are just paying attention to it. And I think unfortunately with the AI boom, there have been so many uh, sort of winners that are kind of unfairly or fairly categorized into this like tech bro billionaire category that makes it just a very hard, makes it an easy target for a lot of folks who are not in the industry. And I, as a marketer, obviously I'm like, somebody needs to grab a hold of this narrative, because I still think that compared to any other industry, tech is one of the most inspirational sectors, where when you follow the exits and the outcomes, you really see how like it is quite democratized. Like, there is not, in traditional finance or consulting or law, you really do have to have gone to the right schools and worked at the right places to get to the top. And here, I mean, you see extraordinary outcomes of people who have built, incredible businesses and companies, and they come from all different backgrounds. And so I sort of choose to be inspired by that, if that makes sense. And, I mentioned I work at AngelList. We saw that in the data. So I work really closely with Abe Ottman, who I know you know. And when it comes to early stage venture, so anything pre-Series A, we cut the data like 100 different ways. I'm like, please give me some nugget where it's like, did you know that founders from this part of the country are most likely to have a great outcome? We cut the data every way imaginable. And the conclusion is that early stage venture is just wildly unpredictable. And you can take from that whatever you will. You could take from that's like gambling. That's like I decided to take from that, that is actually extraordinarily inspiring, because that means anybody can start a company. That means anybody, there's no monopoly on building something that people will love. And so that's kind of why, I decided to make this more of a full-time thing. And, I think that going back to my own point about venture being a long-term asset class, like unless you're committed to doing this for like 20 years, it doesn't really make sense. I think the ZERP era, and especially being an AngelList, you saw a lot of tourists kind of come in and start a fund and sort of see like, oh, what is this like? And my conclusion, having gone through that myself, is like, okay, if I am going to commit to this, like it's got to be something I see myself doing and enjoying, because I think whether you're having fun or not is actually very closely tied to how long you stay in it. For at least 2 decades. So
There were some horror stories from the ZERP period. I mean, can't name any names, but there were certainly stories about GPs raising a fund and then using factoring services to pull forward the fee income, so they got like a big lump sum up front.
oh wow.
Yeah, it's quite scary stuff. But that aside, let's ignore that for a second. The point about tech being inspirational and like egalitarian and good for growth, good for people generally, like that's all a message I'm 100% on board with. And it's always been interesting to me. Trying to share that same message in Europe is harder. Particularly the issue of employee stock options, which generally speaking, adoption in Europe is quite low, which is really weird to me because it's literally like sharing the ownership of the means of production with people. Like it's borderline socialism to give equity away to everybody. But like Europe,
which
for some
Europeans
reason,
should love. Yes,
exactly. They should be all over that, but it's not in the culture. It's a bit too risky, I suppose. There haven't been enough outcomes to prove that it's worth doing. But it's a real shame because like that's the dream, and if everywhere was like that, I think the world would be a better place. Not to get too soppy about it.
Yeah, I mean, I definitely see the irony that you're pointing out. I mean, what I'll say is there are industries that are, linear and exponential. I mean, I think SaaS had such an incredible run. I'm talking about it in the past tense because it's really unclear what's going to happen. SaaS had an extraordinary run because the margins were extraordinary. You could not point to a traditional business that could do this like hockey stick, right, growth. And so that became like a mindset and a default for a lot of people in the way that they made decisions in their lives. And so the way that I explain this to, friends in the Midwest or whoever, I'm not even saying that they're, because I'm not sophisticated, just this is a crazy industry, is just somebody like me who didn't intend to work in tech, who, very, very middle class. My dad was a college professor, my mom was an engineer. We did fine, but it wasn't like, we were fancy. We lived in Buffalo, New York, if you know where that city is. Very blue collar town.
I do.
Okay. And, how I'm able to raise a family in San Francisco and sort of, have the privilege of being part of this ecosystem. It was really because I was an early Facebook employee, right? And I was issued equity and things that I did not understand at the time. And I think that there's a greater understanding of it by the average 24-year-old, which is what I was when I started working at Facebook today. But it's the equity that actually moves people into a social strata that they otherwise like really, it would have been much less likely for them to reach, if that makes sense, right? And that is actually pretty inspiring. Like how many people you can decide. Again, your mind does these things where it clings onto the data that it wants to. It's like you can name all these founders and executives who were born on third base and like, we're going to have an extraordinary life no matter what. Sure. And you can make yourself depressed thinking about those stories. But there are people like me who, I was just very lucky to be a part of a rocket ship. And, there are also a lot of downsides for having your first foray into a venture-backed startup be Facebook, because now like my example of like what a startup should be like is like Facebook. And every founder that I meet is like, I'm comparing them to Zuck, right? These are like high bars. But at the time I'm like, no, this is the average, outcome. This is the average experience. But my point there is, I think that is pretty cool. And when you think about, when you zoom out and you look at social economic mobility, people generally don't move outside of like whatever they were born into. And I have experienced it, of course, firsthand, and I witnessed it. And I'm part of an ecosystem where I'm seeing sort of these bets that people make on themselves and also on the companies that they join and the missions that they want to be a part of, produce like really extraordinary outcomes. So yeah, I mean, if there's a campaign in Europe and that wants to tell these stories, maybe that would make a difference, but I'm not sure.
A number of people have tried, myself included, but
Really?
I'll not give up hope that
Yeah, good.
there's still time, maybe for the UK particularly. You mentioned liquidity and like liquidity horizons, obviously stretching further and further at the moment. How do you think about getting secondary liquidity, taking a little bit of money off the table? Like, this is always a debate. Do you want to sell your winners? Like, how do you know when to take some money out? How do you think about that?
Gosh, I have so many thoughts and so many perspectives on this. I think that traditionally it has been something you hold forever and ever. And that was when we had, an open IPO window. And even if the timeline for a company to have an exit was quite long, they eventually did exit. And I think eventually, founders didn't start unless they intended to get to that sort of like finish line and not settle for whatever, in between. When I was a Facebook employee, we were going public. I think Facebook at the time was, it was like the longest time period a company had stayed private, right?
Hmm.
That seems like a very short time compared to some of the current companies, right? Like I like to remind people I was a Quora employee, a early Plaid employee, an AngelList employee. Those are still three private companies. And it's been, I joined Quora in 2016. So it's been 10 years. And so these timelines are getting even longer. LPs are not seeing, returns long past this 10-year window. And so I completely understand the impatience and almost this broken social contract, in some cases like literal contracts of the expectations around the outcomes here. And then also I think there are cultural things. Like I think Ron Conway is a great example of somebody who loves to share that, he was a very early investor in Airbnb, and I don't think he's ever said he's never sold anything, but he's still held on to a majority of his position, right? And every time he reminds people of that, you get all of these founders say, "Oh, I want an investor like that." And so you have this almost like cultural backdrop of like, at least in San Francisco, I don't know, I can't speak for everywhere, where founders are looking for investors who are going to be with them, for the long run and however long that is. And so you've got that against the backdrop of LPs who, understandably are like, what is your strategy for delivering liquidity? Like when are you going to be satisfied on selling a position? If you have an opportunity to take, however much off the table, will you do so? So it's an interesting mix. What I find very fascinating, because I know you spend a lot of time on Twitter, I am also terminally online. I love seeing these takes of people who I consider not in the Silicon Valley ecosystem talk so boldly about, oh, you need to take some off the table. Founders should know that, it is their responsibility to let investors, exit. This isn't this. Sure, that seems very practical. But I think if you're here and you are part of this ecosystem and you have access to great founders and opportunities to invest, I do think it really matters that you are, somebody who's going to be with them for the long run. Do you see where I'm going with this? It's like,
For sure.
so the loudest voices who are like, sell, secondaries, this is just responsible. They're not wrong, but
Hmm.
I also think that there is this cultural backdrop in San Francisco where, if you look at the data, like 90% of early stage venture activity right now, AI companies, it's happening. There is this kind of like the elite founders, and let's be serious. If you're a founder and you're taking all that risk, you consider yourself an exception. Everybody considers themselves an elite founder. They want this ideal sort of like outcome of all of my first investors who stayed with me through the entire journey. They're going to go ring that New York Stock Exchange bell, and just like all the greats that came before me, right? And I think I'm unique in that I have the experience of having been an early employee, right? So when um, Facebook was still private, I think there was active litigation against Second Market or whatever one of those big platforms where they're doing private market selling and buying.
Hmm.
And so Zuck was like, sort of reminding us like you cannot exercise like this is you can't do anything with your stock until there's an event. And so that scared me. I was early in my career, I wanted to have a long career. I'm like, okay, I can never sell anything. And then when I went to Dropbox, which was the next venture backed startup that I worked at, Zuck was like an advisor to Drew. So Drew kind of put the same, culture in place of like transfer restrictions, nobody can sell. So I think because my like background is being an early employee in a company whose culture was very much like, look, I'm sure there's always going to be buyers, of hot companies, and they're going to go after employees who might be seeking liquidity, but we don't tolerate that, basically, right? And so I've held that like throughout my entire operating career, and I wonder because I don't have an answer to this, and we probably won't know for a couple of years, like what's the equivalent today of a 24-year-old, who's working at OpenAI or Anthropic, who's probably getting insane offers, to do a forward sale or some sort of transaction. What is the culture internally, and then sort of like how do they think about it individually? Because if there's a lot of folks like me who are like, oh yeah, it would have been nice to be able to take some off the table, when Plaid was in super high demand and had really high prices in 2021, right? And so I think that I'm curious how like this will change generation by generation, especially with the backdrop of all the AI boom that we're in now.
It's certainly a lot more like socially acceptable today to sell, even for founders, like early on
For
to take a
sure.
little bit of money off the table, which I have mixed feelings about. Let's say
Mm.
I'm not. I'm also for even for employees, like maybe the experience that you had of having to wait so long for the payoff is like what has made you a good investor since then, because you're patient, and that's obviously very important.
I think that to kind of go back to the data point that I was making about AngelList, it was like we debate portfolio construction. What's better, a diversified fund or a concentrated fund? We debate follow-on reserves, have them or not, or all these things. And like for for most of um for most things, it's like what fits the manager? What is the best strategy or philosophy for that manager to have them engaged, sticking with it, having fun, and so there aren't black and white rules here. And so so that's why I think that the cultural backdrop actually it matters significantly. Because there's so much nuance to it, right? And so it's kind of like you got to pick whatever philosophy or strategy like fits you, and keeps you in it.
Yeah, I mean, there's another GP I follow that I'm a fan of, Sarah Cohn of Social Impact Capital, and she's
Hmm.
posted in the past, the only rule of venture capital is that there is no rules, which also
Yeah.
connects with what you were saying earlier about trying to dissect the data to find some winning formula, and finding that, again, like the formula actually is that there's no formula. There is no rules, there's no pattern, there's no recipe to follow. That kind of is the magic of venture capital, I guess.
Yes, you didn't ask this directly, but I'll answer. It's like, what do I look for in very, very, very early stage companies or founding teams, right? And the data, the takeaway from the AngelList data, and even my own, I've made 55 investments now across funds, angel portfolios, all this, um, is just teams that stick with it will. That's like really the only correlation between when you look at positive outcomes. It's that the team stuck with it. And I do believe, because this is kind of how I built my whole fund strategy around my investment strategy, you can underwrite stick with itness. Even a young founder, you can look at them and look at their life and say, is there evidence that you stuck with a very hard problem for a very long time? And to me, that is actually a really important signal that I'm looking for and what I'm underwriting, during the very long duration that I work with founders. So my sort of like elevator pitch is that I invest in founders pre-pitch deck before they have a very polished story. because I get to really see who they are and what are all the inputs that go into that story, and sort of help them and co-create. What are they building and why, and who are they and why are they leaving, an exciting AI company in this moment because they're dying to build this thing that needs to exist in the world. And so that process can take many weeks, it can take months, and I get to really know who these founders are at the end of the day. So that's how I find my investments, and it's also how I find fun. Like I think this is a privilege to be able to do.
For sure. Yeah, and that's logic, the focus on determination. I think certainly Sam Altman's talked about that as a key thing they focus on at YC.
Mm.
It's the real, like, it's the if there's something to look for that is indicative of success, that stick with itness, I like the way you put it, is definitely
Yeah,
there.
and to the what we were talking about earlier about how big venture has gotten and
Hmm.
how much activity there is, and how when something becomes popular and more mainstream, you get people flocking to it, right? There's a ton of noise. And so I think right now, you look at the sheer number of companies there are. Like if you just look at them on paper, wow, all these companies look great. You should back every single team. It's more likely than not. Like whenever I open up like my inbox, I like have a filter for like anything that comes in through my website. I read every single one, and it's like every single team is extraordinary, and they're all building something great. Because I think that we're kind of in this gold rush right now, right? Where anybody smart and ambitious is like considering starting a company right now. And so how do you cut through the noise is this like fundamental question. And not to get too super cynical about about this next point I'm going to make is like I think that one thing that's happened is the category has gotten so much attention and sort of like prestige that you have more traditional like prestige seeking people coming into the category. And this has not traditionally been an industry that had that or
Hmm.
required that to win. So what I mean by that is like, you have a lot of folks who went to all the right schools, who worked at the right places, who are like, okay, the next high status move for me is to start an AI company. So I'm going to put together a deck and put all the fancy logos that I've been a part of, right? Me and my team. And I'm going to go raise, a $10 million seed round. And they often do. And so in an environment, but like in the data, in my own track record and sort of my own lived experience, those folks do not have any advantage of whether they're going to have a successful outcome or not, right? And so you have a lot of confusion in the market. You have people who are, because of their own background, biased towards people who look more like them, from that perspective. Like you have to really sift through the noise and figure out where you get conviction and how you find your winners. And I'm a marketer, so I'm going to be just obsessed with this differentiation point. But in San Francisco, money is a commodity. Like I said, like my neighbor was an angel investor. I didn't even know. Like everybody has a fund, everybody has some check that they can write into a great team early. And so you have to know kind of like what your unique place and right to win is in this very big ecosystem here.
For sure. And maybe the sad paradox of venture capital is that the opportunities that are easiest to raise money for, like, usually aren't the right ones, or like are less likely to pay off, let's say. And that's a really hard thing to come to terms with, both as an LP, also as a GP. That's
For sure. I think the consensus point, I mean, we talk a lot about consensus these days, and the sort of piling onto winners and the concentration of, yes, there's an extraordinary amount of capital going into venture, but when you really look at it, they're going behind a couple of funds or they're going behind just a couple of companies.
mhm.
And for the rest of us, it actually is, kind of business as usual. So it's hard to sift through that noise, and it's hard to sort of read that nuance if you're not, in it every day, right? Which is why those headlines actually I think really do matter for like public opinion.
Mhm. For sure.
Yeah.
Well, we have a few regular kind of quick fire questions that we finish with. What's the best piece of advice you've ever been given?
When I started working at AngelList, Naval was quite active. We were launching a product that he was very passionate about called Rolling Funds. I don't know if you remember Rolling Funds, but it was a 506c fund, quarterly subscriptions. It was almost like this SaaS approach to being an LP in a venture fund. And so he was around the office, like he was like in the office. This was right before COVID. And so I asked him for all of the advice he was willing to give me about investing. And so I always like to pass on, because Naval is a prolific angel investor. He's the founder of AngelList. And so some of the things that he said, that at the time I nodded my head and I was like, yeah, that sounds right. But like only this many years later do I fully appreciate what he was saying. Was like, if you're starting to make investments, choose whatever sector, stage, check size, whatever. Like no opinion. Everybody's got their own personal situation, but like think about the variables that you can control, because early stage startups, it's such a wild and unpredictable journey that you don't want to throw your own chaos into the system. So what he said by that was like, pick a number of years, like almost create a budget for yourself. It's like, okay, I'm going to write. And then also, if you're going to do angel investing, 10 checks, like 10 companies, like plan to at least invest in 10 companies, because then you have a chance of capturing the power law, was sort of like his logic. And then make your check sizes consistent, because that's something that you can control. It's a variable you can control. And that is such a hard thing to do, because sometimes you're so excited about a company. You're like, oh, I have so much conviction. I'm going to write a 30K check. And then you're like, oh yeah, this team seems good. Like, yeah, no, I want to support them. So I'm going to write a 5K check. Actually, you are throwing your own chaos into the system, right? So he was saying, like, think about how much you want to spend total over a number of years, create your check size. And then what was the last one? It was like, well, the other variable you control is your own process to getting to yes. Right. So it's like, if you have a bad day, if you have a good day, like, again, like really think about what you can control, because you cannot really control the outcome of what happens to that startup. And so I think those are, everything he said there absolutely turned out to be true. And I like to share that advice with people who are like early in their, sort of angel investing journey, whether or not they think that they were building a track record and one day want to start a fund.
Well, that's great advice. And, obviously it comes from a legend as well. So unsurprising.
Yes. Yeah.
All right. Last question is, if someone wants to get in touch with you, what's the best place? Where can they follow you as well?
Yeah, I'm on Twitter, like Helen_Min, and I'm on LinkedIn. My website is articulatecap.com. You can reach me there as well. So yeah, thank you. Thanks so much for the opportunity. This was fun.
Oh, thank you so much for taking the time. It's been great. And, maybe we'll find a time to do it again in future.
Would love that. Thank you.
Brilliant. Thanks a lot, Helen.